Good morning and welcome to the DOTDIGITAL Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Milan Patel, CEO. Good morning, sir.
Good morning, Alexandre. Good morning, everyone, and thank you for attending today's annual results presentation for DOTDIGITAL. We'll start with a summary. I know some of you would have followed the story, but for the people that haven't, I'll give you a quick summary of what we do, where we are, a little bit of history of the company, and then go straight on to key highlights, strategy of the business, and what we see coming forwards. If I just move on to the first slide. In terms of, we've been playing within the digital marketing sector, more specifically in the MarTech space, over 20 years. We're a global business centered out of three main hubs. UK being our hub into EMEA, our New York offices being our hub into North America, and our Sydney offices being our hub into APAC. Now, when we describe hubs, it's having every single department that you can really scale from as you either drive more market share in the region that you're operating or pushing further into the continent as you see demand. In terms of number of employees, we have over 470 employees now at the time of writing this presentation, predominantly focused around product and engineering, sales and marketing for the go-to-market, small team around professional services, and then the rest in back office. 8 international locations. So as I talked about the hubs, from the New York hub, we have offices in the West Coast, so into LA. They predominantly sell into North America. And then a little bit of demand that we're seeing within the LATAM market. From the UK hub, we serve our offices in the Netherlands, into Poland, South Africa, from an EMEA standpoint. And then into APAC, we also have offices in Singapore. Some of the newer territories that we're playing into one of them being Japan, where we've got some exciting things building in the Japanese market, and we'll talk you through shortly. In terms of, for us, we're very much focused in the mid-market and enterprise segment of the verticals, but we also have many different use cases for the platform itself. If I describe the platform, I tend to look at the platform in 4 main areas. One being around the data. So we have a customer data platform that will be aggregating data, whether it's behavioral data, whether it's data that's coming in from their CRM, whether it's data coming from e-commerce platforms. But for us, it's about making it really easy to bring data in so that you can be very relevant and targeted in the communications that you're doing. In terms of the middle layer of the platform, we describe it as the orchestration engine. That's where you can start creating either one-off campaigns that you may be wanting to send, or really driving automation through the customer journeys that you're building. Whether it's around customer acquisition, whether it's around retention, marketing, everything can be set off in the orchestration layer. The third part of the platform is really providing all the different channels that you can communicate on, whether it's email, you want to do email marketing or drive a transactional experience from an email standpoint, but pretty much every single channel that you can kind of communicate on today is all within the platform, whether it's SMS, in-app push, it's plugging into Messenger software like WhatsApp, etc. And then you've got the reporting and analytics layer, which really brings everything together. It's really helping our customers optimize on the return on investment they're making, but also really allowing them to understand what is working, what's not working, and the ability to continuously experiment with their marketing to really drive relevancy. And some of the reasons why people choose us, where it's not just the technology, it's also the expertise and people. That technology and people proposition really makes us successful. In terms of the 3 key areas for organic growth is around 3 main pillars, whether it's around geographic expansion, strategic partnerships, and product innovation. So we measure that by revenues, both from a growth standpoint and a proportion of overall group revenues coming from these different continents. Just over a third of our revenues now comes from international markets, and part of the strategy to diversify more revenues outside of the UK. From a strategic partnership, this is not OEM models or true reseller. Our strategic partners really help us endorse the platform, help us market within the user base, and connect for our customers to really use our best of breed integrations to connect the data together. We have just over half of our customers now integrated into one of the platforms that we've built integrations into. In terms of the third area around the R&D, we spend about 12% of our group revenues on R&D, really focused on driving functionality, not only for what the mid-market requires today, but also what we are from what we're building to innovate into the future and what things are coming 2-3 years down the line, as well as really driving competitive advantage through the functionality set and the depth of the platform. What we talk about is sustainable growth opposed to hyper growth. It's really driving double-digit top-line growth with high profitability margins and then generate that into cash. If we look over the 10 years, but also over the 15 years, we've continued to deliver double-digit growth with a 20% plus operating margin, 30% plus EBITDA margin, and a close to 100% EBITDA to net cash from operations generated. Over the 10 years, we've CAGRs of top line 19%, strong EBITDA CAGRs of 17%, and strong cash CAGRs of 24%. So for us, it's about helping the many different verticals for the use cases and the challenges these customers are trying to solve. It's really making it easy for marketing departments without having the expertise in-house to really drive marketing communication across the different touch points that they have with their end recipients. We like that. We like the diversified mix. Our largest customer represents less than 2% of, from a margin standpoint, of the group revenues. Top 100 customers represent just over 17% of group revenues. So we're not reliant on any one customer across the different variety of different verticals. Have over 4,000 brands that use the platform, over 50,000 active users on a monthly basis. So just taking you through the highlights of the financial year, strong double-digit growth performance, strong cash generation through the period. You would have seen some of the uses of cash. We acquired, 2 months ago, we acquired a company called Fresh Relevance. And as we go through the presentation, we'll talk about the rationale and why we felt that was a strong acquisition to really drive product differentiation and depth in the platform. We have strong leadership team experience. One of the areas 2 years ago that we had some challenges in was North America. Really addressed that through the last 2 years, driving not only strong leadership and experienced leadership team, but also a team that supports the execution layer. Data and analytics is where, if you would have attended our presentation around 18 months ago, that's where we were focused. We really built out the data capabilities within the platform. And over the last 12 months, we've really been enhancing the functionality around artificial intelligence, machine learning, really making our marketeers a lot more efficient in the campaigns that they're sending, which naturally has led to a higher uptick in return on investment. If we take where the market has evolved and how did the market start? So originally it was about email marketing, sending one content to everybody. Then it was around marketing automation. So really automating some of those campaigns, understanding a little bit more about the subscriber base and effectively being able to tailor content to omni-channel, where you can then use lots of different channels to communicate on. Where I believe the market is going over the next 3 to 5 years is really building on the customer experience at every touch point that you have with your end recipient, whether it's a positive experience, a negative experience that you're really trying to drive into a positive one, whether it's transactional messaging or around marketing messaging. And post-period, the acquisition really drives through the use of fresh relevance or augmenting both of the functionality sets. It's about also driving your web experience. We have a very strong balance sheet, no debt in the organization, which really leaves, for me, capital deployment around organic and future acquisitions that we may be willing to do. Over the last 12 months, 10% organic growth, strong recurring revenues of 94%, and Alistair will go into a lot more detail around how the makeup, but also strong profitability. We've also seen average revenue per customers increasing, and that's a combination of existing clients increasing volume of messages, more data coming into the platform, or whether it's a subscriber base that continues to grow, as well as larger value customers or larger customers that are looking to consolidate their stack to DOTDIGITAL. In terms of cash, that grew 20% in the period, and we've kept the dividend in line with our EBITDA growth, so a progressive dividend policy, and recommend a 1p dividend per ordinary share. So I'm going to pass you over to Alistair to go through more of the financials.
Hi, I'm Alistair Gurney, for those of you who I haven't spoken to before. I joined the business a little bit over a year ago as CFO, and I've been sort of trying to focus on how we can optimize our recurring revenue growth and high margin revenue growth, whilst maintaining the very strong shape of the P&L that the business has nurtured over recent times. So Milan's touched on some of this already, but just to highlight the strength of the business over a sustained period of time and how we've managed to maintain some of these metrics. So revenue growth has been very stable. There's been some positive lumps as we had some one-off revenues benefiting at the start of COVID. But even since then, the CAGR for the last 3 years has been 14%. The average revenue per customer growth is slightly ahead of overall revenue growth. And what we're seeing is some of the legacy customers who signed up with the business when we had a much simpler proposition, much more sort of less complex use case, ideal customer profile. Some of those customers have not grown with the business necessarily and simply look for the lowest possible price from some of our competitors. Whilst it's a shame if those customers leave us, it's not entirely unexpected. And the flip side of that is that we now compete for many far higher value opportunities with larger enterprises and smaller business, but with much more complex requirements from their vendors. And as such, we're winning higher value contracts to replace any of the smaller contracts that we lose. And so we see the revenue per customer increase slightly ahead of revenue in most, well, certainly in recent years. Cash generation remains strong. By the end of the year, we were close to 53 million of cash. Obviously, we've deployed about 90 million of that post year end, which we'll speak more about later. Now, the makeup of the revenue is good. So we have about 94.5% of our revenue is what I would describe as recurring or repeating. 79% of the revenue is forward contracted recurring software revenues, which we get about 90% gross margin on. The balance between that and the 95 is repeating revenues, which typically relate to SMS messaging, where it may not be forward contracted with a customer, but we have a strong trading history with that customer and we have fairly predictable volumes from them. To put it in context, over the last 3 years, that volume has gone approximately 8 million, 9 million, 10 million in round numbers. So it's a predictable revenue stream, if not a forward contracted one. It is, however, a slightly lower margin than the contracted software revenues, where it's pure transactional SMS. That might be in the order of 14, 15%, up to 20%. And where it's marketing SMS messages, which I'll talk on in a little bit more detail shortly, that margin could be between 25 and 50%. Now, cash conversion is still, it's a shade under 100% this year. It's 99.6%, and only because one debtor that had told us they were going to pay on the last day of the year paid 2 days late. So I'm frustrated by that near miss, but Still a good statistic overall. So revenue growth, top line revenue growth was 10%. It was marginally ahead of the expectations we had for the year, and part of that was supported by some of the SMS growth we had. Now, thankfully, most of the SMS growth we're having is in the marketing SMS space. So we've got two buckets of SMS: transactional stuff, which is like if you have a parking app, you park your car, you get a message that says you've got 10 minutes before you need to get back to your car, or you can increase the length of time by paying some more. And then there's marketing SMS. This is where we're providing an additional channel to our platform customers who want to communicate in an omni-channel way with their customers. And where we're selling an SMS to these people, it's good, whilst it is margin dilutive to us, because as I say, it's between 25 and 50% margin, depending on the part of the world you're in. It shows the customer is more embedded with us. They're using us for a broader range of functionality, and those customers typically have lower churn. So although it's not as high margin growth as selling pure software, it's definitely it shows a strengthening of our customer base when that happens, and that's what's driven the growth in excess of the second 9% we guided the markets to. Now, and it's that mix effect which has been the relative drag on the gross profit margin, I should add. We've touched on average revenue per customer already, but if we look at the regional mix now, in North America we got back to a stage of revenue growth. Now I know 2% is a very modest number, but we were doing this on the back of a period of stabilization. We'd lost much of the sales team a couple of years ago in North America, rebuilt that team. They've been ramping up. If you looked at this on a half by half basis, there was a small dip, a flat bit, and now we're back into that growth stage. So the actual period on period growth, if I look at bookings, this is the contract we're signing as opposed to the revenue we're recognizing. That growth, H2 on the prior H2 was approximately 25%. So a real change in trajectory as GMR, general manager there, has brought in a new team and ramped them to start to see a positive outcome there. Now, it'll take a little while before the whole team is firing and delivering their full quotas. And it's only at that point we'll pile in more resources behind them. But very promising progression from that team on the ground. Now, our administrative costs grew year on year. There's a few drivers in there. One is the return of travel and expenses. Obviously, the prior year we had a lot of constraints as a consequence of COVID restrictions. So a return to travel and face-to-face meetings. The full year effect, or the effect of a pay rise that was awarded around the business for approximately 12% at the start of the financial year. If you think back to July last year, we were kind of peak cost of living panic, relatively high staff attrition, and at that time the economy hadn't softened, so there was still a very competitive labour market. So there's been no equivalent pay increases at the start of this year, so we do expect to see a little bit more sort of leverage of our headcount coming through this year, and then obviously significant growth in headcount through the year, which Milan's spoken about, and we'll speak more about as we go through this presentation. Balance sheet is strong. Basic working capital profile remains very similar to prior years. There's always lumps and bumps around the year end, depending on the exact phasing of invoicing, both invoicing of overages to our customers and invoicing of SMS consumption to us. But no shocks or surprises in there. And I think that's you can see that's the case by looking at the cash flow. Now, the cash balance is that we're now running at kind of mid-30s, having spent a large portion of the money we had at year end on Fresh Relevance. Fresh Relevance is not cash consumptive, so it's not a drag on our ongoing cash flows, albeit it will be margin dilutive in this year. So it has a lower operating profit margin than the rest of the DOTDIGITAL group, but that will be normalized back to group levels by FY25. And as Milan already highlighted, we remain debt free. Now, the cash flow side here, I think, largely speaks for itself. And I think we've spoken about most of the themes on here as we've gone through the performance of the business. So I won't dwell on this, but it's in the presentation. If there's any questions, do feel free to raise them. Anything I would highlight is obviously we still have a significant cash balance, even having spent a chunk of it, and are working hard on building the M&A pipeline to try and deploy that. Now, Milan will talk about the strategic route we're taking and what we are looking for in that work.
Cool. Thank you, Alistair. So just going through some of the strategic updates. One of the things I wanted to bring to the forefront is, I guess, there's uncertainties in the current climate around what goes on, what's your long-term market drivers. One of the questions I've been getting is, well, what happens to marketing budgets, more specifically around digital marketing, as you have a more uncertain world and it's discretionary spend for quite a lot of businesses. So what we've continued to see is digital marketing as a proportion of overall marketing budgets continuing to increase. So displacing some of your traditional marketing budgets, or even in advertising, coming into more digital where you know who you're speaking to. There's also been a focus not just on customer acquisition, also on retention marketing, really driving experiences at the different touch points, as I mentioned at the start of the presentation. However, I've got a few industry stats and also independent surveys that have been carried out. 76% of business leaders plan to either invest more or keep the same amount of budget within digital marketing. Still generates the highest return on investment from all digital marketing. Email still generates the highest ROI from all digital marketing channels, and digital marketing from an overall spend perspective, from a marketing landscape, that also generates the highest return because you can measure it. It's more cost effective. You know who you're speaking to. Also, what we continue to see is an increased take-up of different channels within the overall customer experience, whether it's around SMS, whether it's WhatsApp in some of the Asia countries that we operate within, but also in-app push, where a brand has not only a website experience, but also a mobile application. It's making sure that you have that consistent message across every touch point that you have with the end recipient. You're seeing an increased usage of data, more and more data coming in, drive for zero-party, first-party data, but also the industry in its own right continues to grow. The TAM is estimated, depends on which research you look at, but the TAM is estimated at about 6.5 billion and growing at a CAGR of about 10%. The fresh relevance side of things is a little bit more greenfield. It's still early in the journey or life cycle of a market where you're really driving, based on data that you have on a person, a unique experience or one-to-one experience when they not only visit the website, but also the campaigns that are being sent out. That represents about a TAM of about 1 billion, growing at around 23% year on year. And what you've consistently seen more in the uncertain times is really people looking to consolidate their stack, choosing a vendor that can serve majority of their use cases, but is a bit more all-in-one than just different point solutions that they may be using. One, to drive efficiencies across their marketing department. You only have to learn one platform instead of multiple platforms, but it also allows you to really piggyback on the full experience opposed to just looking at different point solutions and how you integrate that data into one place. So the growth strategy, I mentioned it at the start, very focused, keep it simplistic within the organization around the 3 growth pillars: geographic, product innovation, and strategic partnerships. From an organic standpoint, really expanding our product suite, making sure our sophisticated marketeers are doing more with their marketing strategies to really drive that return on investment. Very much focused on building on those customer relationships, really delivering what our customers have chosen us as their vendor of choice or partner. But also what we describe as our land and expand strategy. As we've seen the pipeline continue to build with whether it's larger enterprises or higher value customers who are deploying the platform out across many different territories, many different brands, we're very focused in making sure we continue to deliver. Growing our customer base globally, and we've continued to see that across the 3 geographic areas which continue to grow. And really, as I mentioned at the start, our proposition for go-to-market is not just the platform, it's also the people that really bring everything to life. So continue to globalize our talent pool. Very much focused on our strategic partners, whether it's the integrations we have within the e-commerce platform space or integrations into CRM, but that continues to increase as we look into the future or the next 12 months. We've really built in integrations into ERP solutions, into point of sales, as retail customers are trying to marry up in-store data with online data, as well as into customer service software. So whilst we're focused on organic and that continues to grow double digit, we also look at complementing our organic growth through acquisitions. And you would have seen that through the acquisition we did 2 months ago. Majority of our acquisitions that we look at is really to enhance the functionality set for our customers within the platform. So looking at adjacent technology, more from a bolt-on perspective that gives us product differentiation, but also ultimately what customers are looking for. So if we turn to geographic expansion, we've already touched on some of the areas that, or some of the challenges that we had 2 years ago, as other competitors that weren't really focused on profit margins were really driving higher base salaries, etc. We weren't playing in that market. You fast forward to where things are today, it's more of a level playing field. People are looking at profitability of customers opposed to just pure discount and buy market share at any price. We've seen, and Alistair touched on it, we've seen an increase in the bookings rate, but also as you look into Q1, that's grown quite strongly. Last time at the presentation, I was talking about a U-shaped recovery in the North American market, and we see that now coming through. So where we had some of the challenges that came, the growth rate was double digit, came down to about 3% in the half year, came to flat. So we didn't decline in region. It was really much focused around the existing customers. As we put more sales and customer success teams back in to the region as we rebuilt it, obviously there was time in terms of ramp up or enablement within the region. Second half grew faster in order to come back to a 2% in local currency growth. And as we go into Q1, that's grown even further from there. So very much happy with what's gone on. We have a highly experienced team and very much that have been playing in the marketing automation space. EMEA growth, very strong, 9% in period. Whilst e-commerce, I talked about the sales cycles for e-commerce procurement is slightly longer than it has ever been. However, that opportunity has not gone away. So they are taking longer, which means a higher pipeline value, and that grew 3% in the period. However, what we saw in the EMEA market, where we are the largest for what we do, we saw the CRM connectors grow over 20%. That was 7% the year before that. And that's a combination of like-for-like sales cycles, as well as a bit more focus from a sales and marketing perspective around non-commerce customers. In terms of APAC, that led the charge in terms of growth. That grew 19% in the period. Strong growth from the ANZ market, so that's where we operate from. However, some of the Asia regions that we've been investing over the last 12 months, both from a go-to-market perspective, but also professional services teams in region, has continued to grow quite strongly. One of the areas, obviously still very nascent in or smaller proportions of the APAC revenue, is Japan, where we started to dip our toe in the water, as I like to call it, where we can understand the proposition, what our market viable product looks like, what our pricing and marketing strategy needs to look like. That early indication is very strong. We have a translated UI into Japanese. We have local people in region, but it's been one of the fastest growing from any country that we've gone into in terms of building that partnership network. Also, if we look at some of the unit economics in terms of sales, the percentage attainment to sales targets has been very strong in the Japanese region. Also, the customers within the Japanese market are a lot larger from an ARPU perspective, so close to $4,500 per month in region, compared to the overall book of business, which is around £1,600. I just wanted to take you through an example of what we're seeing as the market changes to consolidate stack, but also you see some of the larger enterprises where, from a behavioral perspective, are not just looking at customization, they're looking at more SaaS products that either serve 94, 95% of the overall functionality set. I can't name the conglomerate. However, this conglomerate has over 8 different fashion brands, operate across the many different territories across the globe. We originally signed them up in APAC, and then signed a different brand in the EMEA market. What they were internal advocates when procurement started in North America. They were looking to really consolidate the MarTech stack across all of their brands, across the different territories. That obviously led to an RFP. We closed that in Q1 of this new financial year. That resulted in the customer spend from around about $100,000 on an annual contract value, so annually, to $900,000. So you can see that the platform scales. It can cater for the larger enterprises and the number of users, but also we continue to have a strategy on not just winning new business, driving existing customer growth, but also landing, building those relationships and expanding across the different regions. So looking at product innovation, over the last 12 months, I touched on quite a lot of the AI features. I will talk you through some of that, because a lot of companies go out and just build one bit of functionality and call themselves AI companies, whilst we've infused a lot of the functionality across the whole platform. And we'll take you through some of the examples and how that helps make our customers' marketing departments a lot more efficient. A lot of work has been going on around the reporting and analytics layer. In the RNS, I talked about the total economic impact study that we did with Forrester that we commissioned. Our customers generate about 409% return on their spend over a 3-year period, which is one of the strongest in the whole competitive landscape. We've also seen strong adoption of the integrations that we've been building. So it's 2 types. Strategic partners are very deep integrations, and typically the end user does not leave the platform, where they can kind of piggyback on our functionality. And then we also have other integrated technology partners or other technology business systems where there's a lot more in terms of data synchronization coming in for driving that relevancy across their marketing campaigns. We saw an 100% increase in adoption of the integrations that we've built. Some of the accolades, independent verifications. With G2 Crowd, it's based on customer feedback or customer reviews that really differentiates us into the different categories that we are leaders within. However, one of the areas we measure from the R&D we spend and the monetization is what we describe as a functionality recurring revenues. That's a combination of license, that's a combination of data and bolt-on functionality our customers are using. As they become more sophisticated or their business grows, as they are successful, that generally in turn means we're more successful. That grew 11% in the period. So Winston AI is, as I said at the start, we've got various different functionality points. So it could be through the algorithms and functionality built through our data science teams, as well as using ChatGPT across the platform, natural language. So lots and lots is going on around AI and what we've built. So things like content creation, things like subject line recommendations, using Winston AI to drive split testing and making sure you're getting the highest return on whether it's the subject lines, and then making sure all of the campaigns go out with the higher open rates, or it could be many different metrics, as well as content review from a tone perspective. So we're getting a lot more marketeers using that functionality, Could even be turning an email campaign into 160 character text. You can ask Winston AI to turn that into an SMS whilst making more efficiencies. As well as we look into the future, lots more functionality is still going to come through in analyzing data. It could be recommending areas that that you can really drive a further, more personalized campaign. So lots of work going on in there. But as well as using ChatGPT across the platform to make departments more efficient, we have lots of different other smarts, as I call it, so a functionality point. We have over 80 smarts in the platform that are really driving AI efficiencies across the platform usage. That has been one of the fastest adopted since launch ever, from the functionality that we've put out into the marketplace. That's being used now 25,000 times a month, considering we have 4,000 customers. I'm not going to go through all the roadmap themes, but key areas we focus on is really bringing data in seamlessly into the platform, allowing our customers to scale and grow with the functionality that we build out, but also as we've built lots more functionality and depth to the platform, is being able to really discover that as part of the usage and adoption. We are looking to use some of the kind of PLG or product-led growth motions as we look forwards to really drive a higher growth rate, as well as really allowing our customers, without having any expertise in-house, to drive that exceptional content and personalized real-time experiences. So strategic partnerships, that grew 8% in the period. We already talked about some of the key areas. One of the questions I believe we've got already is around the Shopify connector. That led the charge in the e-commerce connector space. That grew 19% in the period, and that continues to grow pretty strongly. But also some of our other e-commerce connectors, things like Magento, BigCommerce, Commerce Tools. We're connected and have a more agnostic approach, building those deep partnerships, making sure we continue to deliver on the use cases of our e-commerce clients. In terms of the CRM, that grew 22% in the period, led by Microsoft Dynamics. And that's been the focus around working closer together with Microsoft to really drive brand awareness across their user base. I believe I've had another question in terms of what other ERP systems do we connect into. That's things, so we connect into the Microsoft ERP stack. We connect into NetSuite, which is a recent integration that we've done. So we have been accelerating a bit more of the investment around the R&D on integrations, really making it easy across business systems to aggregate data, use that data, and then triggering off or continuing a marketing automation journey. So we touched on it, and we talk about technology and people. If we see what we have spread across the different territories that we operate in, predominantly in technology, sales, and customer success, was also nice to see at the peaks. We probably, when the media was talking about the Great Resignation, elements of that, we were probably peaking at about 22% annual attrition within our organization. That's now come down to less than 12%, and it's probably close to 10% after the first quarter. So a lot of work has been done around that. Average tenure, obviously, we hired quite a lot of people, really taking advantage of the talent that, unfortunately, some of the SaaS businesses that were really focused on a hyper growth model were laying off. We were fortunate that we are profitable. We talk about a sustainable growth model, really taking advantage of the talent. We added about net 70 people through the period. But what's also nice to see, and I'm proud of, is that it's a highly engaged workforce. It's really believing in the vision and us continuing to deliver against the vision of what we're looking to do over the next number of years. So we touched on a little bit around fresh relevance. When I took over CEO of the business around 8 years ago, we really started building up the ecosystem, whether it's around our partners, whether it's around our technology. One, to test the thesis of what our existing clients are willing to buy or want more of, as well as what helps us complete the proposition from a new customer acquisition perspective. And one of the partners there was Fresh Relevance. We've been a partner for 5 years. They have 300 customers, and we've got 60 joint customers to date. I guess where I talked about the MarTech stack being consolidated, more and more customers or prospects are looking for an all-in-one solution. It made total sense to really bring to the forefront, whilst we had a lot of the outbound channels, some of the inbound channels, really using all of that data points, using the functionality to then drive a more personalized web experience. So what does it do? Well, it drives a higher ARPU. It creates more enterprise deals with the capabilities that it can do, not just from the campaigns and engagement that they're sending out, but also augmenting the customer experience from a website perspective. It broadens the sector coverage and really increases the customer stickiness. Also, we've identified strong opportunities within upsell in our own customer base. Obviously, we've had the benefit of the 60 customers and looking at the characteristics of those. It adds for the ARPU spend, it adds in the further 50% to the ARPU when a customer chooses both the technologies together. But with DOTDIGITAL, the other bit it does is really by integrating the two technologies together, it enriches our customer data. So with DOTDIGITAL, you're talking to identified customers, whether it's identified through other interactions or data you're bringing into the platform, or people that are engaging with your campaigns. In terms of Fresh Relevance, a lot of the visitors are anonymous. So by tallying both of those two data points, it then identifies more visitors on your website, really bringing that end-to-end journey, but also a higher return from the data that is being used. So a lot of you that have attended the presentation previously would have seen the platform and the functionality in the core areas that I talked about, whether it's around data, the orchestration layer, the different channels. And for us, there's a number of things that the Fresh Relevance acquisition adds from a technology standpoint, whether it's around the website channel, whether it's around the orchestration layer in terms of real-time personalization across the different channels, dynamic content, being able to really put things like smart blocks, as we describe it. It's a block that comes in that can be changed based on behavior, and also the start of UGC or user-generated content. So whether it's product reviews that you want to bring in, whether it's company reviews, it allows us to really bring all of that information into one place to then drive a more personalized experience. So looking ahead, we like to focus, not try and do everything all at once. The key priorities for us for FY24 is really converting some of that larger, higher value pipeline that's been coming into the funnel. Really growing whilst we continue to build the technology, the depth in the technology, it's growing that awareness and of the capabilities across the different regions. Very much focused in the R&D around the CXDP or customer experience data offering. Ongoing appraisals of potential acquisitions. I talked about around synergy technology, bolt-on acquisitions that can really give us even more product differentiation, a greater depth in the customer experience space, and maximizing on the benefits of the Fresh Relevance acquisition. So what have we got? A very strong playing on the front foot, strong growth in the different regions, strong monetization opportunities around the platform, growing strategic partnership base, but also positive trading momentum as we've gone into Q1 of the financial year. Higher value customers coming on board, but also existing customers sending more messaging. Momentum in the industry, digital marketing growing as a proportion of overall marketing budgets, a growing pipeline for the enhanced proposition, really delivering and continuing to deliver against those organic growth pillars I talked about, whether it's around geographic, product innovation, or strategic partnerships. We do have strong favorable market growth growth drivers, but also a strategy to support the execution of those opportunities. Highly visible SaaS revenues, 94% recurring, of which 79% is forward contracted. Robust balance sheet, no debt, so giving us the ability to continue to invest organically and through acquisition points. Alessandro, I'll hand back over to you.
Perfect. Milan, Alistair, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Milan, Alistair, if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you both at the end.
Yeah, do you want
to? Fine. First question we have: how is growth of revenue from Shopify trending? So growth of revenue from Shopify is strong. Well, it was very strong until last year, right? So the last year we have seen some stress in e-commerce world. That's not just us; that's the e-commerce vendors themselves. So it's been a level of challenge in Shopify, in BigCommerce. Anyone we speak to, I think we've still achieved 19% from our Shopify connectors, which is I would say ahead of expectations for the market. If you break down their overall revenue growth and you pull out payments, I think we would be doing very well within their ecosystem, and particularly so in some of the regions that are not as well served by the large North American competitors to us. So your Asian markets in particular.
Just to add to that, obviously we play within the Shopify Plus space, not just in the kind of core Shopify. So our ICP of clients is more mid-market. We're still early on that opportunity. So whilst there might be decision making that's taking longer, we're still being able to convert across the whole Shopify customer base.
Next question: I will summarize. Have we modelled a scenario in which we cut back investment to maintain steady ARR? I mean, yes, I've modelled lots of scenarios. It looks great for a year or so. You can make several £1 million a year by not spending anything on sales. You probably pay back R&D and marketing as well. But we think it would be a pretty quick race to the bottom when we've got a group of competitors internationally who invest well and invest a lot. So I think it'd be very challenging indeed to maintain the existing customer base we have unless we continue to innovate, continue to show momentum in a marketplace and demonstrate our relevancy in that marketplace. So I mean, you suggest it might be unwise in your question. We agree it'd be very unwise, so we're not going to do it.
However, adding to that, what we've consistently done is talked about a double-digit organic growth rate with 20% plus operating margin that we've consistently delivered 15 years of us being a public company. So revenue growth does get invested back. That's, we can see the CAC to LTV ratios going in the right direction. So for us, we will continue to produce a 20% plus operating margin, 30% plus EBITDA margin. The rest of the growth will be invested back.
I mean, to the extent there's largely a trade-off between revenue growth and margin. That's not perfectly one-to-one, but it's not far off. I think in general, a balance of a good growth rate and a positive margin is a good thing in today's economy. I think having growth only but no margin is probably a little bit scary, and having lots of margin but no growth is generally not very appealing to investors. So hence we'll stay with the middle ground that we have.
So one of the other questions we got: which ERP systems do you currently connect into? So I believe I tried to answer that as we went through the presentation, but just a reminder: Microsoft ERP, NetSuite ERP. We have whilst Salesforce talk about really building out the different categories into a wider ERP, we connect into Salesforce as well. And we'll continue to look at what demand our customers have and the areas. There is also, whilst those are more deep integrations, there's the ability to use our integrations platform as a service element to connect into any ERP solution. We have a number from a basic data synchronization into the platform, as well as they have their own ability to connect into the APIs to push data into the platform.
Question on headcount growth. Do we expect similar headcount growth increase in FY24? No. It's a very short answer. There will be, from a reported point of view, which looks at the average through the year, it will look like headcounts going up. And also the acquisition of Fresh Relevance brings with it around 70 people. So the headcount will increase as a result of that. But if I look at it on a like-for-like organic basis, actually our exit run rate from FY23, plus or minus a dozen roles, will probably be our exit run rate from 24 as well. So as reported, it will look like it goes up, but we're not really hiring except to backfill roles or reallocate resource. There's very limited net growth at this moment in time.
And for us, it's about growing into the headcount that we've added, making sure that they're enabled and are producing more from a go-to-market perspective. The other question that we have is
potential for upselling. Can I take that one?
Yeah, go for it.
Yeah. How much potential is there for upselling more functionality to existing customers? Is there a lot of headroom for growth just from existing customers? Yes, there is. So I'll say there's broadly 3 buckets that I would put the headroom into. One is an increased volume of consumption of existing products. That is people having more contacts, more messaging requirements. We see that trend every year. It's one of our major drivers of growth, and one of the reasons we like the pricing model we have, which will increase the cost of the platform depending on how much you put through it and how much you use it. I think people are generally much better at acquiring new contacts than they are at cleansing their databases, and that is great for us. So there's growth in that area. There's taking more functionality that we already have. And this is taking our customers on a journey from a relatively basic use case of needing a list of customers and send some emails to it, through to giving them a true omnichannel solution using SMS, MMS, and all the other channels, and using some far more nuanced data segmentation capabilities and some of the functionality which can be driven once you've done that data work. And now that adoption profile is something we work very hard on. It's one of the things that really justifies the work we do on R&D. And I think the proportion of customers we have in our top bundle, if you like, is growing very effectively at the moment. So we're deploying that, and you see that with new product releases around AI. We will, in due course, be building various tiers of that into our pricing strategy and working with it. The final category is additional functionality which we don't currently offer. So this is like Fresh Relevance was. So it's extra adjacent functionality we don't currently have. Now, to the extent there is a market, and in some cases it's a brownfield market to kind of take over, displacement market to take over that functionality. Obviously, that's money that's already being spent by the customer. It's just a case of getting it to move to us or acquiring the business that they're already spending it with. And obviously there's significant growth there, because reality is, as of a total global marketing spend point of view, we represent an absolutely minute slice, because there is a lot of other functionality we could potentially offer. Yep.
So another question is, if e-commerce connectors grew by 2%, but Shopify connector grew by 19%, which connectors contracted? So we saw a slight contraction in the Adobe Commerce connector, partly because they have larger customers. One of the things we have seen, obviously, with larger customers, there's a lot more people involved in decision making. So whilst in a period at the moment, we've seen that contract, we're seeing higher value opportunities that could come from that, where they're in the pipeline.
Yeah.
So that's one area that has contracted.
The other thing I'd highlight there is there's a real asymmetry in terms of size of some of these connectors. So 19% of one doesn't mean that another one went down by 19%.
Yeah.
I think it was more like -2% offsets the +19, because Shopify, as we said, is starting from a much smaller base. It's a much newer relationship for us than the Magento one.
Can you please elaborate on your tax rate? Why is it so low, and what do you expect going forwards?
So obviously for most of the year we've just reported, we were still enjoying 19% corporation tax rate. But also there's R&D tax credits, the big thing that goes on, which reduces that further. So there will be an increase in that tax rate of time because the mainstream corporation tax rate has increased. And we will continue to work to take advantage of whatever tax credits and tax optimization, let's say, is available with our own knowledge and the advisors we use. So.
Cool. For the SMEs that wants to improve its digital marketing ability from basic CRM use to exploiting your omni-channel platform, is there some form of roadmap you offer? There must be loads of potential customers in this situation. Yeah, so whilst we talk about our ICP or sweet spot customers being in the mid-market and enterprise, we also have small business that are graduating to a mid-market platform. So the way we've built the platform is you don't have to have any expertise. So the step up from a drag and drop technology perspective is not as big from when you use I'm just throwing some names out there that are really optimized platforms for the small business segment, like a MailChimp or a Klaviyo or a Constant Contact. You won't see a big leap in terms of the ability to create campaigns efficiently. The other bit is we then take them on an incremental journey. So do you want to add a integration? You just need to put your username and password on, and then we do all the heavy lifting. And then you can start to then really deploy the different omnichannels. So there isn't a big step up for small businesses that want to use our platform and get using it. Where Alistair mentioned we are losing some of the small business, that's where they don't, their marketing strategies are still are in the developing stages, so they won't see the advantage or the value in the depth of the platform because they just want to get a campaign out, single content to everybody. So that's where we're probably the pricing curve would work better with a small business vendor. However, as you want to drive more experiences across your customer base or recipients, that's where the pricing curve optimizes and you see the value in the technology. So I think, we've got a few more. Any plans for a capital markets day to show shareholders the AI and fresh relevance functionality? Yes. At the moment, in terms of the integration, there's a number of things that have been done from a platform perspective. One being, obviously, they were a partner of ours, so some of the functionality actually is integrated into our campaign editing, as well as the marketing automation customer journeys. One of the more recent things we've been doing is a single sign-on, so you can you don't have to leave the platform. You're able to then piggyback off of the different functionality points, whether you're a .digital customer or a fresh relevance customer. As we look into the next 6 to 12 months, we'll be integrating more of the functionality to drive an all-in-one platform in order to take advantage in the depth of where the market is today. To simply answer the question, yes, we will be doing a capital markets day to do the demos of the platform, but that probably is about 3 to 6 months out.
I think on that we're probably out of time for further questions, unfortunately.
Yeah, Milan, Alistair, thank you very much for being very generous with your time. I think you've addressed all those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Milan, could I just ask you for a few closing comments?
Yeah, thanks, Alessandro. So for us, some of The key messages for the last 12 months, it was a year of double-digit growth, strong cash generation through the period, 94% recurring revenues. And we've continued to execute against our growth pillars, whether it's the progress in product innovation to push further into the CXDP space, whether it's growth across all of our regions, North America, EMEA, or APAC, but also the strategic partnerships, more so in the last 12 months around the CRM partnerships that we have. For us, the opportunity from a market perspective continues to be favorable and growing. The digital marketing budgets as a proportion of overall marketing budgets continues to grow. In terms of, for us, the new year has started well with a robust financial position. The company is now stronger in business, both from a foundational perspective, but also opportunities with a more comprehensive offering and a clear growth path. Thank you very much, everyone, for attending today's annual results presentation.
Thank you.
Perfect. Thank you once again for updating the investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Digital Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you very much, everyone.